To begin with, I think the first and most obvious observation from the BOJ's playbook so far is the steady pace of action. The BOJ has stated that it prefers to allow the dust to settle in between monetary policy tweaks, and that's to allow them to better assess the impact of their moves, which at minimum it leaves us safe from another rate hike for now. So also, the announced pace of reduction of the BOJ's monthly bond buys as announced in the July monetary policy decision, I think we can see it as quite measured. And it was only announced after consultation with market players, which does suggest that the bank is eager to keep the pace of its monetary policy normalization predictable to some degree, and emphasizes a desire to not cause alarm. So also, the BOJ has shown a willingness to be quite forward-looking when it comes to raising rates. As most can see, economic activity still remains quite weak. At minimum, it wouldn't inspire confidence that a rebound or strength in the Japanese economy is forthcoming, and that kind of runs counter to the case for the BOJ to consider rate hikes. So you can see they've banked quite a lot in the narrative of trusting in a cycle of price increases taking hold, and that's kind of been underpinned by the strongest wage gains in decades. However, we can't really take these observations into account without the context of recent developments. If we briefly take stock of our current situation, the BOJ has raised rates twice so far. Once in March, first in 17 years, which was also the end of the negative interest rate policy, and once just a while ago at the end of July, and that takes interest rates to their highest since 2008. As of this recording, markets have sold off quite spectacularly, concentrated in Japan, just following the last rate hike by the BOJ. Nikkei 225 itself dropped by more than 12% on Monday, and that's at the tail end of a 3-day drop, which totals about 20% in losses overall. In the context of the recent sell-off in Japanese assets, I think that the general consensus here is that the BOJ will have to think twice about another rate hike in the near term. At the very least, expectations for the BOJ to raise rates at the same pace are likely out of the window for now. So I think most would have put a move either at the end of October or just before Christmas this year if there wasn't this shift in considerations recently. So on another front, things over in the US are also looking a little better for the US-Japan yield gap in recent weeks, and that's come as market pricing for Fed rate cuts as what I would describe as it's become really optimistic. So regardless of what drivers of that move over in the US have been, I think that the BOJ is probably a little wary of adopting too optimistic a read of recent Fed rate cut pricing. So if anyone can recall, OIS were actually pricing in 6 or more rate cuts in 2024, and that was at the beginning of the year. And that went all the way down to just 1 cut, for 2024 that is, and now it's back up to 3 cuts. And of those 3 cuts, there are odds for at least 1 or 2 of those to be 50 basis point cuts. So, optimism or pessimism, that aside, at minimum, that kind of volatility in expectations, it will not allow policymakers to use that for determining a path of monetary policy. In fewer words, perhaps, recent optimism about Fed rate cuts, it is unlikely to change enough minds at the BOJ, regardless of what markets think about the outlook for the yield gap. So on another point, I think political pressure will play less of a role in the coming months. Going into the July meeting, it's hard to deny that political pressure on the BOJ had been mounting. Some have speculated that it may have contributed in part to the decision to raise interest rates. And, I think that is something that is very hard to confirm, definitely, at minimum. So while it is right and proper to insist that the BOJ and other central banks are independent institutions, it is still fairly unusual for politicians, and in this case, perceived heavyweights within the ruling LDP themselves, no less, to actually suggest what the BOJ should do. So while that may have in some part helped to drive the rate hike in July, I think when we take this in a context of how some participants or at least the market players, they have blamed the sell-off in Japanese assets on the BOJ. Other politicians, other participants, they will be very wary of piling on pressure, political pressure that is, for further monetary policy normalization. So on that front, we are probably a bit safer. I would expect to see Japanese yields hit a ceiling in pretty short order. So economic data continues to show pretty broad weakness across the economy, and this has come while inflation and wage data, they've both been improving. So the long-awaited virtuous cycle is, as the BOJ says, coming into sight, but there still isn't an arrival date yet. So as Japanese rates continue to go higher as part of monetary policy normalization, I think we can expect to see more volatility at minimum, and actually fragility also in Japanese assets. So most will have realized that the BOJ has increasingly removed guardrails to financial markets as part of policy normalization, and that was always to be expected. However, one such move, for instance, has been the scrapping of the policy of J-REIT and ETF purchases. While it's also, as of the last meeting, they have also reduced the pace of monthly bond buys. And I think this provides perhaps an interesting example. So to illustrate that, how higher interest rates also comes with the likelihood of more things breaking. For instance, yen positive factors may actually spur losses in Japanese stocks. So the relationship between the two is well documented. So in the past, while there were some mechanisms for the BOJ, for instance, to conduct ETF purchases when stocks drop by a certain amount, now there are none, which leaves markets bereft of any official action, as we saw on the 7th of August when the Nikkei 225 dropped by more than 12%.